Welcome, everyone, and thanks a lot for joining today's webinar on mastering franchise funding. My name is Kevin Bitnoski. I'm the Chief Development Officer for SixFour3 Franchising, and I'm joined today by the CEO of SixFour3, Matt Cook, as well as Mike Schoenberg, Senior Consultant with Benetrends Financial, to help answer a lot of the questions that you may have about funding your franchise business. We're absolutely thrilled to have you here and hope that the information we share with you today will help you and equip you with valuable information and insights to turn your aspirations of owning your own small business into reality. So we're about to dive in, but please understand that everybody is on mute right at the moment. So if you'd like, you can use the Q&A button if you have any questions that you'd like to pose to the panel, or if anything's going wrong with your audio or video or things like that. So with that said, let's sort of dive right in and explore sort of this great world of funding your franchise business. Matt.
You want me to take this slide?
Well, you can kind of, I did the intros and you can kind of take it from here.
Yeah. So first and foremost, we want to give you just a little bit of a history on who SixFour3 is. How we started our company, the obstacles we faced when it came to financing and what we did about it. And then want to understand a little bit more about sort of you as a business owner and kind of where you fall, where you fit into this mold. And then we'll talk about some of these options for financing, which I suspect if you're on this call today, this is something that you are facing now, as a possibility of starting your own business. We're fortunate to have Michael with us today from Benetrends, who's going to talk about some real practical opportunities for financing, and then we'll kind of wrap it up. And if we have any questions, we'll go through that at that point. So for those of you that aren't familiar with SixFour3, this is a company that myself and two partners founded back in 2016. We did this mostly out of necessity. We all had girls that played sports, in particular fast pitch softball. And, the facilities that we would go to dominated by baseball, dominated by boys. And we made a decision early on. I think our kids were probably 10 at the time, that this was no place for a young female athlete, just in terms of, confidence issues and other things like that. We felt like it was important to find a place for these girls that they could call their own. Obviously, we're looking for that kind of equality, but we wanted something even better. And so we set out to build this product. We did it a little bit differently than I think, at least traditionally in our business, what you see or how you see these businesses pop up. We decided as entrepreneurs that we wanted to take a business-oriented approach to this. So we didn't come in and want to be the trainers inside the business. We wanted to build something that could scale. We wanted to build something that really meant a lot to the community around here, and then ultimately something that we could build across the country. A couple little differences about what we do. Obviously, this is a female fast pitch only service, so it's a very niche focus, but it's in a growing industry. We're a 24/7 style business. So if you think of like a 24/7 gym, all of our customers have an opportunity to become members. They get their own unique access code. We monitor all of the systems, everybody in and out. We have video for surveillance and security and liability and others. And then the other thing that we really decided early on was we didn't like the rental space business, which is what a lot of these companies, these facilities that are out there do even still today, where they're renting lanes and renting time. Given the fact that these buildings are vacant a good portion of the time, we wanted to do something that was a little bit more business friendly, something that gave us some predictability and recurring revenue. So we set up a membership-based system. A lot of things have developed, since that time in 2016. The product that we put out in front of people was very well received. We opened a second location just a couple of years after the first. Then we opened a third location out of our market down in North Carolina. And then last year started franchising. So it's been very well received. This business model really works well. So we're out there now talking to hundreds of potential prospects, and one of the areas that is always a bottleneck for any small business owner or entrepreneur is, how do I finance this thing, right? And in terms of our investment for what we do, we're sort of middle of the road if you compare us to other franchise businesses, but it's still a pretty hefty investment. Per our franchise disclosure document, our range of what you can expect to fund a business like ours is anywhere from $300,000 to $700,000 to get it to sort of get it off the ground. So it's a pretty hefty investment, and this is a bottleneck that again, most small business owners are going to experience when they go to start up a business. So there are options that you have available to you. And again, Mike will talk a little bit more in terms of specifics as it relates to, traditional bank loans and some other things. But as you're evaluating this, you've got various options. One of those might be personal savings. This is dipping into the savings account and funding the business that way. Not an overly popular option for most people, especially given the risk. Now, all of these have risk associated with them, but emptying out your bank accounts oftentimes isn't the preferred method. But it is an option, especially for those that may be well off in that arena. Other personal assets. So maybe you have money market funds that you can borrow against or cash out. Maybe you've got a stock portfolio that you can cash out. Perhaps you have some real estate investments or real estate ownership that you could leverage or borrow against, or even as something Mike is going to talk about a little bit later, even retirement, borrowing against retirement accounts. So those personal assets are other options that you have available to you for financing your business. This third one here is probably the most popular, at least from what we've seen and in my experience. Is the friends and family route. So, whether that's a parent or a sibling or a long lost uncle or something in that regard, finding somebody that's inside of your own network of even a friend is often a way to finance your startup company. They're friendly faces. You don't need as much documentation. You're probably not putting up any kind of collateral or other assets. And this could either be in the way of what we call debt. So they're lending you money and you pay them back at some rate, or it could be an investment where they're investing for equity in your company. So a pretty popular one that a lot of people use. Another option is other private equity. So maybe these are institutions that exist out there, and there are lots of them, where funds come together with the purpose of investing in startup companies or investing even in franchise companies. There are all kinds of mechanisms that you can use, but a lot of times startup companies are difficult to value. So you can leverage instruments like debt conversions. So if you went to borrow money from somebody at an interest rate, you could end up converting that into equity later down the line. So there's some pros and cons to that as well. We won't dig too deep into that today, but and then lastly, and probably another very traditional method is bank loans. So whether those are conventional loans or loans through the Small Business Administration. And again, Mike will talk a little bit more about that. Again, all of these have some level of risk. If at the very top, maybe you're risking friends and family or personal assets, but you don't have those huge collateral considerations to worry about. As you get down the line there, that becomes a little bit more evident. Generally speaking, a bank is going to want personal guarantees or some type of asset that can be collateralized, whether those are business assets, probably more than likely also personal assets as well. So these are a few different opportunities or options that you may see available to you as you're seeking this out. So as we compare that to what we did, we've kind of used a variety of these, more than one, certainly. When we started this company back in 2016, we did use our own personal financing to do this. So myself and my two partners put up our own capital to get this off the ground and then continue to invest in it as we were developing this model and building out this business. But there came a time where we couldn't do that anymore, and we needed infusion of capital to grow the way that we wanted to grow. So we had a very quick turnaround on some money that we needed to get into our second facility. We chose a path because we were looking for something that we could expedite. We chose a path that was a very high interest rate on our first loan. Ended up paying that back off as quick as we could, but we decided at that time, and for various reasons, that we didn't want to go down a lengthy path of heavy documentation and all kinds of collateral. So we took an approach that is an option that's available out there that was a higher interest, but a lot less collateral on the front end. And we leveraged that to kind of build up our second location. We then actually went out and built a relationship with a local bank in our area. We're just outside of DC in Northern Virginia, and secured a loan for a third location through that bank, and also secured a credit line so that we had available cash when we needed it for operational types of expenses. So we did do the conventional loan. We also did an SBA loan to grow even further after that and to start to scale up our operations. We did an SBA loan, and we finally we did a debt conversion before our equity raise. So that vehicle that I mentioned earlier, we had some people that were interested in investing in us early on, but we really thought we were undervalued at that time, or we couldn't put a big value on the company and didn't want to give up a lot of equity in the company. So we took that money in the form of a loan, and then subsequently, when we raised some additional capital, we converted that debt into this equity. So 2 years ago, we did an equity investment, which meant that we sold a part of our company for cash. And we used that again for continued expansion and growth, and mostly focused on the franchise side. So that's a little bit about what we did. Now, I mentioned this briefly before, but myself and my two partners were entrepreneurs. We had all started businesses before. So, we knew sort of how to do this. We had done it before. We understood the level of risk that we were taking, but we knew going into it what our expectations were. But this is likely one of the first questions that you need to ask yourself is, what type of owner are you anticipating becoming? Is this something that you're going to pursue as a lifestyle business? Maybe it's a second career path for you. You're done with the 9-to-5 grind and you want to do something different and just, reap the rewards of a single unit. Perfectly good, but understand that going in. It'll help you sort of shape the framework of your business. Maybe you're an investor. Maybe you want to find somebody that can operate the system. And we've seen this in our network as well, where we've had somebody who has been very interested and passionate about being an operator in our business, and somebody else who has money and resources that wants to invest in that business. So that's something to consider is what level of participation do you want to have in this new business, or will you have in this new business? We separate small business owner out from lifestyle business. This may be somebody that has, desires to build 2 or 3 units, or, that kind of scale, versus an entrepreneur who, generally speaking, is somebody that wants to, dominate the space or dominate the world. This is the bucket that, that we fall in generally, but there is a difference between these different types of personas. And then there's others out there, and we see these all of the time, where you're not really sure. And in this last bucket, that's where you really need to start to, kind of answer the questions. What do you want to do? How much risk are you willing to take? Starting any kind of business is difficult. There's huge risks to it. And in my career, just on a personal anecdote, I started my first company when I was 25. I was single. So, the only person at risk was me at the time. Later, I started another company when I was married, and even after that, when I had kids. And each and every time in different parts of your lives, you have different risk tolerances. But if you're not sure, if you can't answer that question, if you're unwilling to take the risk, it's quite possible that maybe you don't fit into any of these other buckets. But all of this stuff, starting a business, raising money, putting up collateral, they can be risky, but they can also be very rewarding. So understand who you are. Ask yourself that question. Once you've done that, you need to kind of decide what's next, right? Now, we'll make the assumption that business plans have been written and you've done market validation and all these other things, which today's conversation is not about. And you need to figure out, where to go from here. Hopefully, I thought this picture was relevant, but the blindfold ideally would not be, recommended. Hopefully you can do this with your eyes wide open and not your eyes shut, but it sometimes feels like this, right? But if you want to take that risk and you want to go to that next level, you've got to determine how to make that first step. So based off of that previous slide, if you fall into one of those 4 buckets and you've made this commitment and you're going to move forward, you know who you want to be, now you need to figure out what the best route is for you. So we've referenced a couple of different options for financing, figuring out which one is right for you. is important and very, very relevant. As I alluded to previously, we've taken a variety of these routes for different means. But you can also consider these in sort of parallel efforts as you're out there seeking. So you should be talking to a banker or bankers. You should place a phone call to a family member or a friend, or maybe join a networking event, and surround yourself by people who are interested in helping small businesses grow and get financed. But do all of these things in parallel so that you've got multiple options. You don't want to be stuck with just one option. You'll create better opportunity for you if you've got various options at your disposal. The networking groups, the Facebook groups, whatever you can get yourself involved in. It's amazing how you can find somebody that shares your interests, or that you might end up partnering up with. This has happened to us over the years, where we've partnered with people that we didn't know until we met them at one of these events, or met them via a Facebook group. Google a lot. I mean, Google is an unbelievable resource. Chat GPT or any other AI technology is also a great resource for small, startup business owners. But if you utilize these, these tools, you can find a ton of information out there that can help guide you and point you in the right direction. And then lastly, I think just talking to experts, and we're going to transition this over to Michael now, but make sure that you're getting yourself out there, connect to as many people as you can, talk to the bankers, talk to private equity people, and just start having conversations. And it's through those conversations where you'll likely find the path that's best for you. So with this, just as a little bit of a backdrop, we want to bring Mike on and have him talk to you about some more specific types of programs. So Mike, I will send this over to you. I can continue to advance the slides for you. So just let me know as we go through here.
Perfect. Well, I appreciate the introduction, Matt. As Matt had mentioned, my name is Mike Schaumburg, and I work for a company called Benetrends Financial. We are a full-service funding company, and we've been around since 1982. And today I'm here to talk to you about a couple different funding programs, and ultimately how to fund a business in today's lending environment. And as Matt had mentioned, there are multiple ways to go about funding a business. There's really two programs that I want to focus on today. One is a self-funding strategy that would allow you to access retirement funds without paying taxes or penalties through a program known as Rollover for Business Startups. The other is a very traditional way to take on debt, utilizing your own assets to borrow money from a lender via an SBA loan. And after the call, we can go over some do's and don'ts, as well as timelines and ways to coordinate your best funding plan. The first program that I really want to focus on is the SBA. That would be the Small Business Administration. The Small Business Administration was established because people were having a very hard time getting conventional loans for businesses. So the SBA created this program. It's a really good loan program, and it's a very, very common way to fund a business via debt. It's probably the most common way that people take on debt to fund businesses. Now, what Benetrends does in regards to the SBA, we act as a loan broker. You can kind of look at us like a matchmaker and a handholder. We work with about 60 national lenders, and we ultimately walk you through the process of getting pre-qualified, which essentially means that we know we have a bank that would fund your specific project based on your personal qualifications. We would then help you package up that loan and build out the entire application, which I'll also focus on. And then it's moving into getting you some term sheets, underwriting, and closing with a specific bank. So again, a lot of hand holding and a lot of matchmaking. The first thing we really want to do is get our candidates pre-qualified. We don't want to take you through the entire process of building out an application, which is a bit tedious. We want to make sure that we have banks that'll be willing to fund your project. And as a good rule of thumb, there's usually about 4 things that the banks are going to want to see. If you can check all these boxes, there's a very, very good chance that we'll have a bank that'll want to fund your project. The first is going to be strong personal credit. The minimum credit score that the lenders are going to want to see is a 680. That's really what gets you in the door. Anything above that is great, but 680 is really the bottom line for securing an SBA loan. The next two pieces have to do with cash on hand. There is money down that the bank wants to see as a cash injection, and there are also cash reserves on hand that the bank is going to want to see, which is referred to as post-closing liquidity. In a perfect world between both sides, the banks are want to see about 30% in liquidity based off of the project. Usually 20% of that will be your cash injection. I would say on average, we're anywhere between 15 and 20%. In Q1, our lenders were looking for 17. So we play it conservative and usually say, just be prepared to put up to 20% down. 10% in post-closing liquidity is always sufficient. So again, 30% in liquid is usually what the banks are going to be looking for. They consider liquidity anything from cash, marketable securities, and the retirement funds tied to the program that I'm going to talk to you about as well. The only time you would need to provide personal collateral is if the loan amount is over $500,000. So keep in mind that would be after you present the bank with the 20% cash injection. The 80%, if it's over $500,000, the banks are going to look for personal collateral, which usually is tied to real estate, although there are other ways to go about it. Now, when it comes to an SBA loan, it'll always be a 10-year term with no prepayment penalty, so you can pay it off as aggressively as you'd like. And the maximum that the banks can go as far as the interest rate is concerned is 2.75 points over prime. That's the one thing that's really going to vary between the lenders. The higher the loan, the lower the interest rate. So when we package up your application and get it out to the banks, we're really trying to get you as many term sheets as possible so we can get as aggressive as possible on those rates. Now, once the pre-qualification is in hand, that's us saying you have a 98% chance to receive funding from one of our lenders. After that, we're going to help you build out the application. And that's the last thing at the bottom. The main things that they're going to look for is a resume and a business plan, along with a pro forma for 2 years, a personal financial statement, and 3 years of personal tax returns. So it is a bit hefty, but we'll help you write all of that. We can go as far as writing that business plan and the pro forma for you. It really just depends on how much legwork you want us to do. And then it's progressing you through the process and ultimately closing on that loan. I'd say about 75 to 90 days, start to finish, for the SBA process. But that is definitely a really good debt service program. The other program I want to talk to you about today has to do with pulling out retirement funds via a program that the IRS calls rollover for business startups. Now, in this example here, it shows what it would look like if you were to take out retirement funds as a distribution. And that's one thing that we're always taught, right? If you pull that money out, you're going to pay taxes and you're going to pay penalties. So here I am coming along explaining to you that when you utilize something like this, that's not going to be the case. But I do have an example of here of what would show if you were to take $200,000 out of a retirement plan via a distribution, you would be stuck paying state and federal income tax, which could be about 30%. And if you're not at retirement age, you would have to pay a 10% early withdrawal penalty. So I think a lot of times this is the reason why people say, don't use your retirement funds, because out of that 200,000, you're probably only going to be left with about 120,000. Now, if you utilize the program that I'm about to explain to you, you would actually get access to that full $200,000. And it all revolves around a specific structure that we ultimately set up to get you access to that money. And the next slide will show you exactly the steps that we take in order to get access to those funds. Now at Benetrends, we call this the Rainmaker Plan. The IRS calls it the ROBS program. Not a great acronym, so we use the name Rainmaker. Our founder actually established this program back in 1982. I apologize for my dog in the background. The mailman is here. They are having a bit of a fight. That should not last long. But anyways, the ROBS program is basically a way to reinvest your retirement funds into a business without paying taxes, as I had mentioned. It really revolves over getting that money into a new retirement vehicle and investing it into the business from that retirement vehicle. So what my company does is help create a structure that allows you to get access to those funds. The first thing we need to do is establish a corporate entity for you to operate the business out of. Now, within this program, we ultimately need to buy shares from the business. So what we do is we create a new corporation and design a retirement plan for that corporation. The corporation will be in your name and the retirement plan will also be in your name. Once the retirement plan is established, as an employee of this business, you would have the ability to roll your retirement funds into that company's new plan. That is the biggest difference between what we're doing and the distribution that we talked about, which would incur taxes and penalties. This is not seen as a distribution. It is simply a rollover. As long as that money stays in a retirement vehicle, you'll never pay taxes on it. So once the money gets moved into the new plan, our plan has a unique investment option that says rollover funds can be used to buy stock from the company that sponsors it. When that transaction takes place, the money moves into the corporate checking account. It is seen as an investment and not a loan, so you don't have to pay it back. And now you have access to all that tax-free money to use as any sort of working capital that you would like for the business. So there's a very big difference between utilizing pre-tax dollars and utilizing cash on hand that perhaps, or you've definitely already paid taxes on. So this is kind of a way to look at it as cheaper cash for the business to be used by itself or in conjunction with any other type of financing. Now, there are a couple different benefits to using the program. I think the biggest one is that you're not paying taxes or penalties on that money. You're saving yourself about 30% and playing around with, that much of the IRS's money. It's also based off a provision that's been allowed in retirement plans since what's called the ERISA Act was established in the early 70s. Our founder is an ERISA attorney. That's kind of the background on how he was able to formulate this structure. And that provision within the IRS is what allows us to get access to that money. And that's the one that says rollover funds can be used to buy stock from the company that sponsors it. Now, again, said that pre-tax dollars can be used to fund the business. There's really not many other ways to do something like that. But there are a couple different ways that you can use this program. Now, one of the things that the banks are going to look for is the ability to have a salary while you're looking to fund the business. It kind of goes in conjunction with having that extra 10% cash on hand. The banks like to see income while you're pursuing a loan so they know that you can handle your everyday life and the everyday debts that you have. One way you can utilize the rollover program, if perhaps you're not employed, is to supplement the income from the retirement account once it hits the corporation's bank account. Another positive reason to use something like this is because it helps minimize or eliminate debt altogether. Again, being that this is a self-funding program, you don't have to take on as much debt if you don't want to. The other main reason I really like it is because it's a lot faster than most type of financing programs. We talked about the SBA being about 75 to 90 days start to finish. The rollover is about 2 to 3 weeks max, can really get funded in as little as 10 days. And I'll harp on it again. You can always use this in conjunction with anything. If you want to use some pre-tax dollars to go get an SBA loan, you can absolutely do that. It really just gives you more options. And that's the best thing, right? Like Matt said, it's always good to have options so you don't have to pigeonhole yourself into one specific program. But that's really it when it comes to the rollover, so I hope you enjoyed the information there on both sides.
Yeah, here we've got Michael's information. You can jot this down and we can send it to you afterwards if you have any additional questions for him. It's a unique program, one that was new to me, that I think has a lot of value. Even one of the things you said there at the kind of at the end, Mike, to be able to leverage a program like this for a conventional loan or an SBA loan, I think it makes a ton of sense. So, Kevin, do you have anything come through?
Yeah, we do have a couple of questions. One and one in particular, we'll start kind of right with picking up where Mike left off with the Rob's program, the Rainmaker program. Is can this be used if I have partners? Right. So for instance, I'll use Matt and I. If Matt and I are partners and we create this corporation and we both have, 401ks or retirement programs that we can roll over together into this new corporation. Let's say we're 50-50 partners, but we're rolling over different amounts. How can we do that? Is this a program that can be used with partnerships in the corporation?
Yeah, that's a great question. So, bottom line is you can use as many people and as many retirement accounts as you want, because what's ultimately happening is all those funds are getting consolidated into this new retirement vehicle that we set up. So you could have multiple partners, you could have multiple retirement plans. At the end of the day, it's all going into the same pool and buying the same shares from the business. Now, when something like that happens with partners, to get a little technical on the retirement plan side, both partners would be established as trustees of the plan, which means both partners would have voting rights in the company. So that is a very good way to utilize it if perhaps you do want to bring on a partner. And to actually explore that a little bit more, you can also do it with retirement funds and cash. Say the other partner doesn't have retirement funds, they just have cash on hand. You can do the same exact thing and buy personal shares with your cash.
Okay. So it's just how you set up your capital stack, basically, at that point.
Exactly. And I would dig into a little bit more detail, on the one-on-one calls to explain it. But very easy answer is yes, you can have multiple people come in with retirement funds.
And just while you're on that intro call concept, that the way that our process at 643 works is when we get a new candidate that we've vetted and gone through our portion of the process, we put them right in touch with Mike and the folks at Bennett Trends to sort of help them understand what their options may look like and start doing their due diligence on whatever the financing options are. So again, jot down Mike's contact information here. But if you're moving forward with 643, in any case, we're going to put you in touch with the folks at Bennett Trends anyway. So again, thanks a lot for that. A couple more questions did pop up. How detailed, when you talk about writing business plans and pro formas and multi-year pro formas and things like that, a lot of people have not done that before. So how detailed of a pro forma or of a business plan do people need in order to start a potential SBA or other loan process?
So, honestly, it can be as detailed as you want it to be, but I think the more detailed it is, the better chances you have for a bank to take it seriously and want to take it on. Now, I think I briefly touched on this. My team writes business plans and pro formas. The business plans themselves, they're about 35 pages long. So it really digs into not only personal information and information about the brand, but it's also market comparison information. That pro forma is going to be month over month for the first 2 years. And the banks are going to want that to be pretty much as close as possible to the total investment. Now, there's two ways that we can kind of go about it. I wouldn't let it deter from going and getting an SBA loan, because either way, we're here to help. And whether that's a template and a back and forth conversation or literally writing it for the candidate, we can really do it both ways. But I would say they are pretty detailed. We had a meeting a couple months ago, and the team was going through some of the business plans that they had proposed, and they were between about 34 to 37 pages. So they are pretty detailed.
Okay, that's awesome. And then one other final sort of quick question. I don't know if any of us on the call have this number handy, but does anybody know what prime is right now?
Yeah, prime is 8.5. The cap on the interest rate is 11.25. But I'm going to be honest, based off of the range between 300,000 and 700,000, you'll never get it that high. It'll always be under the cap. And that's the thing. Higher the loan, the lower the interest rate. It is variable. And don't quote me on this, but the Fed is supposed to drop this year. We're hearing 3 times. We're still waiting on it in Q2, but it is supposed to be going down. So that's good for SBA rates.
Right. And just sort of a quick follow-up to that on my own question is, on average, how many term sheets are you getting for candidates?
So it's anywhere between 3 and 5. That's usually where the sweet spot is. I think 5 would be great. 3 is probably the average, but it's definitely multiple to be able to compare it.
Okay.
And are those purely based off of rates, like the decisions on those, or are there other benefits that different banks provide?
So the rates are the big thing, but it's also the lending environment, right? So like if we have 60 banks, there's only X amount that possibly want something in this industry versus another industry. So it's really industry exclusive for certain lenders. So we always have a handful of banks at any time that we know would love something like this, whether it's the investment range or the industry. And it's really just sending it out to them and saying, who wants to take a shot on it?
Got it.
Awesome.
Awesome. Well, Michael, thank you very much. Very much appreciate you being here. And
Thank you, guys.
Yeah, of course. And Kevin, did you have anything else to wrap it up?
Yeah. So a couple things just in conclusion here. If you are interested at all, obviously we need to sort of talk a little bit about 643. Matt gave you the great story about how we the origin story of how we started. But if you would like more information about fast pitch softball and owning your own 643 indoor training facility somewhere in the country, around the country, we'd love to talk with you. Obviously, the QR code here, you could snap a picture of, and as well as we've got all the contact information there. But we certainly appreciate Michael and Matt for sharing some stories. And thanks everybody that attended and tuned into today's webinar on mastering the franchise funding. We hope that the insights and the anecdotes and the stories and the information that we shared with you today were certainly very powerful and valuable to you on your journey toward business ownership. And remember, your dreams are certainly within reach, and we're here to support you in any way we can, whether that's through owning a 643, or if you just like to pick our brains about how we did it or want to get in touch with Michael, obviously feel free to reach out. But again, thanks everybody for joining. We really appreciate Matt and Michael sharing some stories, and you guys go out and crush it today. Have a great day. Thanks. Appreciate it.
Thank you.
You guys.
See you, Mike.